Good morning, everybody. Uneducated Economist here. Thought I'd talk a little bit about the U.S. Treasuries this morning, mainly the 10-year Treasury, because Treasury yields have been rising lately. And the 10-year is like the basis of all loans. Auto loans, mortgages, credit cards, they all follow the 10-year. So wherever the 10-year goes, you can imagine the rest of the financial world is going to go as well. And the reason for that is that the United States Treasuries are like a guaranteed never to default. Alan Greenspan said it. There is zero chance of default when it comes to a U.S. Treasury, mainly because the United States can always print up the money to do it, to pay it. Now, they can't guarantee the purchasing power, but they can guarantee that it's going to get paid. So when a bank starts to loan out money, they can loan out money to the United States government by buying bonds, or they can start reaching out in risk and try to acquire a little bit higher interest on the loans that they give out by lending it out to eventually to us. So that's why the 10-year is like the number one treasury to follow, is because it is like the base for all loans out there. And treasuries move opposite, like the price and yields move opposite to each other. So when yields are rising, that means bonds prices are coming down. And what's going on there is that investors are looking out there in the environment. They're seeing unemployment start to, have better numbers. What was it? Just yesterday we had 2.5 million jobs created, and unemployment dropped from like 15% down to 13% or something like that. I honestly think those numbers are going to get revised, and that it's probably going to be a lot worse than what they are showing there as far as the stats go. But the markets loved it, and as an investor, you can think, well, I can either put my money in the safe haven, because that's what's caused pretty much the treasury yields to drop as much as they have, is because of this pouring of investors going into the United States treasuries, or they could start reaching out for more risk by like putting it in the stock market or reaching out into real estate or something like that. When they start doing that, they're pulling money away from the bond market, whether they're selling their bonds or just not investing in bonds, and they're putting it into the stock market and real estate and stuff like that. So that's why you're seeing the stock market rising as much as it is, and you're seeing bonds start to drop. It was a few months ago that everybody was talking about like a total collapse of the stock market and real estate and stuff like that. And now we're seeing that, the investors are starting to feel confident. And this is one of the reasons why you're seeing the dramatic move in both the stock market and in the bond market. Now, even though the Federal Reserve is really stepping up their efforts with the quantitative easing, or at least they were over the last few months, I have a feeling that they are really slowing down on the amount that they're adding to their balance sheet. And if I was looking at it right, it looks like the amount of mortgage-backed securities that they are buying has really dropped from the previous months. So they're like kind of stepping away from the market a little bit to, I guess, see what the investors are going to do. The whole idea that the Federal Reserve was going to step in and start, lending out money through the lending facilities and stuff like that was to try and get the investors to front run them, to be ahead of the market, to try and step in before the Federal Reserve could start buying these things. When they did that, the Federal Reserve was just like, okay, cool, we did our job. Now we don't have to do anything. And we've talked about this before, but, it's just like another example of that taking place right now. Anyway, I'll leave links down in the description for it. Uneducated Economist, you guys let me know.